Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit the subscribe button. Now, over the weekend, Treasury Secretary Janet Yellen spoke at the Texas Tribune Festival, stating she doesn't see any red lights flashing in the U.S. economy. She even described job growth as solid and said inflation is under control. Let's take a listen.
For the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. I don't see red lights flashing. While there are risks, it really has been amazing to be able to get inflation down as meaningfully as we have. This is what most people would call a soft landing.
Now, we've heard similar reassurances before. In the lead up to the 2008 financial crisis, the Federal Reserve and other policymakers consistently downplayed risks. Fast forward to today, we've got rising underemployment, which just hit 7.9%. And we got weak spots in key sectors like retail and manufacturing. And this week, all eyes are on the Fed with a major rate cut decision coming up. Will they go to 25 or 50 basis points? And how will that shape the markets? We've also got fresh inflation data dropping like CPI and PPI, which of course could completely reshape the narrative. Now, to help break us down and make sense of all of this, we're joined by Peter Boockvar. He's the Chief Investment Officer at Bleakley Financial Group. Now, Peter's got a sharp eye for these markets, and he's here to help break down exactly what's going on. Hey, Peter, welcome back to the show.
Thanks, Jeremy. Appreciate having me on.
Okay, let's jump into Janet Yellen here. I mean, it was an action-packed weekend. We've been hearing some interesting conversations coming from either Janet Yellen or when we talk about Jerome Powell. But at the Texas Tribune Festival, she seemed to sound pretty positive on the U.S. economy. I'll just show you a little bit of a clip of more of what she said here.
When you think about what will drive it, the pace of consumer spending, that's important, and that remains quite solid. We're not seeing layoffs. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. Unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
Okay, so a good, solid economy, Peter. I mean, I can't help but feel like this echoes 2008, like I just said in the intro, you know, when the Fed officials were similarly confident right before the crash. Not to say this is happening here, but is Yellen missing some warning signs?
Well, we have to keep in mind that the Treasury Secretary is the salesperson for the administration when it comes to economic policy. And that's not just Janet Yellen, it's on the Republican side as well. So you can be in a full-blown hurricane and the Treasury Secretary will say, the weather looks great, we see blue skies. So we have to keep that in mind. But that risks being disingenuous. You know, she mentioned that consumer spending is solid. Well, it depends. If you're a high-income consumer and you're booking cruises, well, then yeah, that customer base is solid. If you're Dollar General selling to your customer that's making less than 35 grand, your customer's in a recession. So it very much depends on who you are in terms of what you're experiencing this in the economy. If you're selling vacations, I mentioned cruising, but it could be anything, you're doing much better than those that are making manufactured items, where manufacturing's been in a recession for the last 2 years. If you're building new homes, you're doing probably better than the real estate broker that's trying to sell an existing one, where the pace of those are trading, 30-year lows. So it's an extremely mixed and uneven economy, and but a Treasury Secretary is going to, paint it with a broad brush, and especially 2 months before an election, will make it a point to tell everybody that things are just fine.
Yeah, to your point, I mean, we have an election coming up. There's a lot of talk about how political this can be, the Fed's moves possibly in the next couple of weeks. But with that being said, we go back to what we were just talking about, this divide between Main Street and Wall Street, and it feels like it's never been larger before. Break it down a little bit. I mean, how bad is it?
Well, again, it depends on what area of the economy you happen to be in. If you're anywhere near AI compute spending, you're doing extraordinarily well. If you are selling chips into the wireless telco business, you're not. Or if you're selling chips into the industrial economy or the auto sector where sales are sort of flattening out, you're not doing so well. If you're selling into the smartphone market, well, sales are pretty flattish year over year. If you are building a manufacturing facility that's going to be spitting out EV batteries, well, you're doing okay building that facility because the government has just incentivized the OEM to do that. But if you're making other things, you're not doing so well. I mentioned housing, and I certainly mentioned what's going on with the consumer. And we can also say about the global economy. India is growing 7%, but China's growth is decelerating. Germany is at best flatlining, most likely in a modest recession, but the Spanish economy is doing much better, as is the UK. So there's so many cross currents here that you really have to look big picture and really differentiate the areas of the economy that are doing okay versus those that are not, rather than, like I said earlier, painting everything with one broad brush, because it's not that easy to do when you paint it with a broad brush. You have to look under the hood because the superficial looks are very deceiving.
Mm-hmm. Yeah, and as you mentioned, that global economy not doing very well. Of course, we're seeing some interesting reports out of China, too. We'll get to that in a second. The Federal Reserve is obviously preparing to cut rates next week or this week. Talk to me a little bit about this debate, whether they'll opt for 25 or 50 basis points. I mean, with the weaker than expected jobs data, rising uncertainty, do you think that they're going to be more cautious or aggressive?
Well, the bond market or the Fed funds futures market is pricing in 100 basis points of cuts over the next 3 meetings. So that implies that one of these meetings, we're going to get 50. That's already priced into the Fed funds market. And if you go out an extra year, call it August, September of next year, we're pricing in a total of 225 basis points of rate increases. So it's kind of irrelevant whether the Fed cuts 25 or 50 in September. Because like I said, the market's already pricing in either September or the November, December meetings, them cutting 50. So I think that pricing embedded in the markets already should take out a lot of the drama on what the Fed is going to do. I think the biggest question investors should be asking instead is, what is the extent at which the labor market's slowing? What extent is the economy weakening? And is this inflation drop sustainable or not? Because it's amazing how many people think that this inflation war has been won when all inflation has done is fall back down again. The battle has been won, but the war will only be won when inflation sustainably stays low. But if the Fed, gets aggressive in cutting interest rates and starts stimulating anything interest rate sensitive, particularly on the goods side, and goods prices start to inflect higher again, well, that's not the definition of sustainable.
Mm-hmm. Yeah, we start to see a little bit of these revisions to the data, Peter. It's been so incredible to watch. It's almost like we report what that employment figure looks like, and in a month or two, I'm going to report on it again with the new data.
Right. I mean, it's the jobs data is the most important thing because Jay Powell told us it is. Yeah. And yes, it's one of their mandates, but he has now emphasized that being sort of the main driver now of where they take monetary policy. But at the same time, Jay Powell also doesn't want the embarrassment of him cutting too much. And I gave the example earlier of inflation reversing higher again. One of the other things that I really have my eye on here is the performance of the US dollar, because that can complicate things as well. We saw a very sharp rally in the dollar mid-2021 when Jay Powell said he's thinking about tapering QE. That rally sort of kind of ended in October, November 2022, just as the Fed was ending their cadence of 75 basis point rate increases and started to slow them down. And now you're having the dollar roll over again as the Fed's about to cut interest rates. But the Fed's not the only one cutting interest rates. The Bank of Canada cut interest rates last week. The ECB is going to cut interest rates this week. The Bank of England got off the bench and cut interest rates. So the interest rate differential thing is not necessarily in U.S. favor, but the dollar is weakening anyway. And if Powell gets aggressive in cutting interest rates and the dollar really breaks down, well, then you start to risk rising import prices, a resumption higher in commodity prices. So I think my point here is that people just assume that the Fed has all these rates to cut and everything is just going to be fine because they have a lot of ammunition to respond to any economic downturn. And I'm going to argue that while, yes, they have technically 550 basis points of rates to cut, that doesn't necessarily mean they're going to be able to without a lot of unintended consequences. So I think the days of zero are over. And in the meantime, in the background, we still have global QT. And one of the most important central banks in the world, the Bank of Japan, has told us they're going to be shrinking the pace of their asset purchases all through March of 2026. So there's a lot of complicating factors here. I think the market's way too nonchalant, as I said, in thinking that the Fed just has license now to do whatever we want. I'm hearing about that Fed put again from people, but I just don't think it's going to be that easy.
Yeah, you mentioned these global economies, and they're so tied together. I mean, China's deflationary spiral is deepening, and some are drawing comparisons to Japan's lost decade. How significant is this deflation for global markets? And more importantly, could it have a domino effect on the U.S. and European economies?
You mean in terms of China's?
Yeah, like when we start to see this, this turn down in the economy, first
Right.
China starts to see it. We're going to see it here eventually.
Well, we've been seeing it for 2 years. To me, what's been more of a death bath, 1,000 cuts response to the very sharp rise in interest rates, where some people were affected immediately, those that had floating rate debt, those that had debt coming due in 2022, 2023, and this year. But many had pushed out their debt maturities. But that debt maturity every day gets closer to being realized. And while interest rates have definitely moderated off the peak and the Fed will cut short-term interest rates, I still think we're in a higher rate world, certainly relative to the near zero we saw in the 15 plus years leading into 2022. So I think the global economy will continue to moderate. I say moderate because I'm not expecting, a big slowdown. I'm really thinking more of potential just little growth malaise that we're possibly in the midst of, but still has more work to be done. Now, we'll see to what extent the Fed can offset that with rate cuts, but there are also flip sides to that. One of the benefits to the economy of rate increases is that it gave a lot of people with savings interest income. Now we have $6+ trillion of dollars in U.S. money markets that are getting very nice interest income. Well, you take a baby boomer, to use them as an example, a couple who's 75 years old, they're retired, and they had $1 million in savings. Well, in 2021, that $1 million was probably getting them maybe $5,000, $7,000 of interest income. Fast forward at 5-ish+% interest rates, all of a sudden it was generating $50,000 pre-tax. Well, if the Fed funds rate goes to 4 or even goes to 3, that $50,000 becomes 40, that 40 potentially becomes 30. And the difference could be a cruise. It can be another night out at a restaurant. So it gets to my point again that this is not just going to be so easy that the Fed's going to cut rates and everything is going to be fine. Just as when they were raising interest rates, they were actually benefiting a portion of the population, those that didn't have to rely on taking on debt. Because keep in mind that you have a borrower and you have a lender, and that level of interest rates usually tilt in one of their directions.
Yeah, that's actually well said there. Okay, well, despite Yellen's claims of a soft landing, the markets aren't really buying it. Last week, the S&P 500 saw its worst performance since March of 2023, dropping about 4%. This week, of course, we're seeing buyers back, maybe buying the dip. I mean, I guess the question is here, are the markets signaling that a harder landing is more likely than Yellen's letting on?
No, I think the stock market thinks that everything is going to be fine. I do, though, want to highlight when it comes to the stock market that one of the most important things that I think that has taken place over the last couple of months, and it started when big cap tech started to report earnings, is that the market started to differentiate this AI trade. And you now have tougher questions being asked about this extraordinary level of spend and whether it's going to be worth their while in terms of the returns on that spending. and the ability to monetize it. So in a way, this AI tech trade could be over in terms of the ability of these stocks to basically take the market with it. Now, NVIDIA and the receivers of all that spend, well, their earnings are going to continue to benefit from this, but the rate of change and the rate of growth, as seen with the NVIDIA numbers, is definitely slowing. So if you lose this AI tech trade, the baton is going to have to be passed on to somebody else if we're going to maintain these levels in the markets. And while we hope that will happen, I'm not so sure who's going to be able to take that baton. Maybe value stocks, maybe small cap stocks. Hopefully we're long a bunch of those, but we have to watch to see.
Where are you putting your money? I mean, your wealth advisory group. Talk to me a little bit about what you're looking at. Are you looking at the market today and saying, okay, I should buy this dip? And if so, is it the more aggressive, defensive assets? Are you still in that trade? Are you still riding the AI trade just until we know it's not there anymore?
No, I have acknowledged to people that that trade can be over. Again, in terms of its outperformance relative to everybody else. We're still talking about strong companies generating strong cash flows, but in terms of where are we going to get market returns when looking at over the next 5+ years, it may not be those names anymore after the extraordinary pull that they gave to all of us over the last bunch of years. So we're looking more internationally. We're looking pretty bullish on Asian markets as a play on the Asian middle class that's only growing with half the world's population there. Still very bullish, notwithstanding this pullback on a few commodities. I say a few because we're sort of isolating it to energy stocks, uranium. We've been buying this pullback in ag, particularly the fertilizer stocks, which have gotten completely beaten up. And we like to buy beaten up stocks that to me are more cyclically out of favor rather than a secular situation. And we've been very bullish and very long precious metals for a while and remain so.
Yeah, you've been obviously active within the commodity space, particularly gold. I mean, there was news today that China's central bank has paused its gold purchases for the 4th month in a row, reportedly holding around 73 million ounces. We don't know what comes out of China for data. Every single time I get these releases, I'm a little bit skeptical. But if that is the case, what does this signal for the global gold market? Could China's absence create more volatility? What's your outlook here?
Well, if they're right, which I don't think they are, I think they're still buying. I think they're just masking their purchases. If it is 4 months, well, gold's at a record high anyway. So they're stepping away from the market, if it's true, which it likely is not, really has had no effect. Now, the first month when they did not report an increase in their holdings, the market responded and everyone freaked out. Oh, China's now price sensitive and they're stepping away. But like you said, here we are 4 months in and gold's at a record high. So I don't believe that they're stepping away. And even if they are, the market's absorbed it. And they're not the only central bank that's been adding to their central bank reserves. And now we're beginning to see a lift in Western buying via the ETFs, as there has been some increase in the holdings of gold in a variety of ETFs. So even if they were stopping temporarily, because I want to emphasize temporary, because they certainly don't own as much gold as they hope to own, it's being offset now. And that's why, again, we're holding record highs here.
Yeah, talk to me a little bit about this lower inflation in China. I mean, might it ease global price pressures? Could this happen? I mean, should U.S. investors start preparing for potential economic fallout from China's deflationary spiral here?
Well, if you look at the Chinese consumer, that's right now very stretched because they have PTSD from the COVID shutdowns, or they're losing money in the value of their apartments as the residential real estate market is under a lot of pressure. They're increasing their savings rate because they're just nervous. Low inflation is actually good for them. But the last thing the Chinese consumer right now is, call it 2% inflation, which the Western world has defined as their target rate. It's actually good that there's no inflation right now on the consumer side in China. So we should not be afraid of that. Now, on the flip side, the deflationary pressure on their real estate market, well, yeah, that's where it's painful. And it's certainly in manufacturing as well, with this dip in commodity prices and the recession we're seeing in manufacturing. So this whole inflation-deflation debate is not just binary. It depends on what it is. We actually benefit from the lower cost of living and higher real wages, aka via a rise in wages and a decline in our spending. I mean, technology is the definition of good deflation. But if you're over-levered, deflation could be bad if what you're selling is deflating in price. So I think we also need to differentiate too. Again, it's not inflation good, deflation bad. It depends on where you are. It's bad if you're a real estate developer who's trying to sell apartments, but it's great if you're a Chinese consumer who's just trying to, get to another day here in terms of their spending.
Yeah, absolutely. Well said. Okay, well, obviously we've got key inflation data coming out this week, PPI, CPI. It could reshape the Fed's narrative here. Do you expect any surprises, when we look at this data approaching? Could it delay or change the Fed's approach to easing?
Well, if it further moderates, then the Fed may feel comfortable cutting 50, which is fine. I mean, one of the rules, or I should say not rules, one of the lessons we learned from the 1970s was when inflation decelerated after a spike was not to get complacent. And it seems that now we're back to around this 2%, low 3 or high 2s inflation around the world. Everyone's now getting complacent, thinking, like I said earlier, the war's been won. And I hope inflation stays down, of course. But it's still not necessarily going to be that easy. I still think when things settle out, and after we finish the downside of this inflation fall, that 3 to 4% is going to be the new 1 to 2 for a period of time. And that it's going to still hamstring central banks. And they better watch out because the market will smack them over the head if inflation starts to rise up again over the next year or two after they started getting cute and cutting interest rates again, which I understand from an economic standpoint, we do need some rate cuts. But I think that at least right now, Jay Powell is looking at a rate tweaking cycle, not a rate cutting cycle that the bond market is currently priced for.
Interesting. Okay, well, talk to me. I just want to ask you, because we start to look at this interest rate, being priced into the market, and it's almost like we've gotten used to, as consumers, we're all looking for that 2%. We keep hearing the Fed. Is that reality? I mean, world changes.
Well, let me start by saying that the 2% target is nonsense. And there's no econometric model that says 2% inflation rate actually maximizes economic growth. The reason why they created the 2% level is for their own selfish reasons. Because they thought, well, if inflation's at 2, that implies we'll probably have our benchmark rate at 3 or 4. And if we go into an economic downturn, we would have rates to cut. So they just made that up based on that. Again, not what was necessarily good for economic activity, because I mentioned technology as this disinflationary force. So technology products usually go down. Well, in order to meet 2%, let's just say technology prices fall 2% a year. Well, that implies you need something to go up much higher than that to get to that 2% average. So basically the central banks are rooting for much higher prices elsewhere. So it's a whole nonsense construct that has been created here. And unfortunately, we're all suffering from it. And one last point on this. Remember that the Fed created this stupid concept of inflation symmetry, where if we go through a period of time of low inflation, they would tolerate a period of time of higher inflation. Well, you can be sure that they're not talking about now tolerating a time frame of lower prices or deflation to offset the huge inflation that we saw. That discussion's off the table because of the stupid 2% number that they pulled out of there. You know what?
Yeah. No, I hear you on that. And it's actually funny. They've almost put themselves in a corner here because we got all this data coming out. And then, of course, we got this September meeting. It's 2 months between the next one and November. There's a lot that could go right or wrong between those 2 months.
Right. And also an election where their meeting comes the day after.
Well said. Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, joining us today to break it all down. Appreciate this, Peter. And of course, I was reading your Substack. You're great. We got this Book report. Talk to me about where we can find it.
Yes, Book report. Thank you. Yes, they can go to Substack and type in my name. And Book report has a C in front of the K. And they can read my daily macro and market missives and occasional investment ideas.
Beauty. I appreciate it. Thanks for coming on, mate. Thanks for your time.
I appreciate having me on.
I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We got great content coming all week long, lots of data to come. Stay tuned. We'll see you next time.